As we continue to cover the collapse of Silicon Valley Bank, we've heard a lot about unrealized losses and other jargon for that matter as well. So I want to do a quick breakdown of what unrealized losses means here. Essentially, it's assets that are held on a balance sheet that are worth less than when you bought them. It's like when you have a house that's underwater on your mortgage, for example. Now, most of the time for companies, that is not an issue because many companies, especially in the banking sector, plan to hold to maturity, which might be another abbreviation you're seeing lately or another piece of jargon you're hearing, HTM. And that's what, in theory, Silicon Valley Bank was planning to do with the securities it had bought, hold them to maturity and so therefore not have to book a loss. However, because it was forced to sell them, it had to MTM, mark them to market, which was what got them into trouble and ended up recording a lot of losses on their balance sheet. To talk more about this whole process and the mess that SVB got itself into, we're joined by Myles Udland, editor here at Yahoo Finance. So, Myles, this is an unusual situation in part because the instruments that they were holding, that is treasuries and government debt, like this does not tend to happen with government debt as a general rule.
As a general rule. Now, the other part of that conversation you were having around the HTM securities, the hold to maturity securities, banks also have the AFS, the available for sale securities, which are kind of the same things. You will have mortgage-backed securities in there. You'll have treasuries in there. The real problem that Silicon Valley Bank had is because they had this mass inflow of deposits, they didn't have anywhere to put it other than into securities. Usually, banks will put a large portion, depends on the bank, you can manage it different ways, into loans. They will extend the loan to myself for my house, right? Your house, what Sozzi's car, whatever it wants to be, it's probably financed differently, but whatever it wants to be. Yeah. And so the thing is, when you take money that your depositors give you and you put it into loans, you are taking credit risk. You are worried the money will not be paid back. When you take money from depositors and put it into securities, treasuries in this case, you are taking duration risk. And what that means is that when the rates change, like when the rates go up as they have, you are underwater on, I think, their maturities for securities, something like 5 to 10 years, the average yield was 1.5%. Well, today you get 3.7% on a 10-year. You get 5% on a 2-year. So you are taking a loss on that because you've taken duration risk, not credit risk, with the deposits that came in the door.
What happens next, Myles, if the Fed continues to go ahead with its rate increases? That is one of the key debates here this morning. What does the Fed do? You have Goldman coming out saying maybe they won't do anything at their next meeting.
Well, I think the Fed has been laser focused on getting inflation down. And their view, Powell's view, is that if we bring rates up, inflation will come down. Now, the long and variable lags of monetary policy have been discussed in terms of how long it takes for inflation to come down. The other side of it, and we've seen a lot of strategists come out this morning in our inboxes, say the other side of long and variable lags is what it does to the financial system, which gets to the unrealized losses that you're talking about. Now, of course, the key word there is unrealized. And you are not obligated to realize those losses. They are just something that is sitting there. The problem here, and I mean, we can kind of get into this if we want, is like the second that you, whether you're Silicon Valley Bank or anybody else, take a hold to maturity security and sell it, whether if it's at a loss, only if it's at a loss, you must then mark the whole book, or you have to mark some of the book to that mark. So now you are realizing the losses on your unrealized losses. And that is when you have a major problem for your earnings profile. That's when you have a major problem for, you kind of look at the moves today in regional banks. I don't think all of it necessarily is that it's going to be like Silicon Valley Bank. It just means the earnings for these companies are going to be massive losses they're forced to realize by selling not only their available for sale securities, but also perhaps maybe selling some of their hold to maturity securities.
Well, and there's also the idea, this is something that the FDIC chair actually flagged in a speech earlier in March, where on Monday,
a week ago,
where he said there was $620 billion in unrealized losses. And to your point, the vast majority of those will not be realized, right? Because these banks will not be forced to sell them, but they might be forced to sell some portion of them. I mean, the bank stocks are down for a host of reasons you could argue, but that is definitely a contributing factor?
Ultimately, the bank stocks are down because the earnings profile for banks now looks worse as a result of this. And a lot of this is kind of accounting, machinations or whatever. But, Sozzi, as you know, like when you're an analyst and you're telling someone you should buy this for X times earnings, X times book value, well, if the earnings go down or book value changes, all of a sudden you get a discount on stock price.
Yeah.
Market liking JP Morgan, though. Interesting. At least here in the early going. It could change.
Yeah, I mean, I don't think that's a huge surprise, though, because again, if you're a bank of that size, if you're a GSIB, you have different capital requirements. The JP Morgan does not have whatever it was, 80% of their deposits in securities. They make loans. Right, they're not allowed to, and that's just not how they manage their risk.
Yeah.
Also, they have a chief risk officer, which Silicon Valley Bank didn't.
They also have
so there's
Jamie
that
Dimon.
problem.
There we go.
I mean, look, we can go through the JP Morgan thing, but there's a reason why those 12 banks have a very different profile than Silicon Valley Bank and all the others.
Indeed, good stuff. Myles, I appreciate it.